Well, I think we've got to actually ask, is it a tech debacle? Or is it something which actually the market is doing what it should do, which is it's actually looking at what's happening at disruption at the stock level. One of the things that colleagues of mine often say is, remember, this is a market of stocks. It's not a single entity. It's not a stock market. And I think we often forget that. And what we've seen is huge rotation. We've seen, I think, an episode in the tech trade, which is suddenly a realization that this disruption that tech is causing generally, actually, they're going to do some of that to their own sector as well. And as a result, I think the market is struggling or attempting to reprice that. But if we actually look at the sector overall, and remember, we allocate off top down, not at the stock level in my particular line of business, actually tech and comm services are down 1% to 2% this year as sectors, after having risen 120 and 60% respectively in the last 5. So yes, we see single names getting hit quite hard as their business models are being questioned. But the overall tech trade, we think, is actually becoming a little bit more resilient, if anything, because you're getting this pricing differentiation happening, which is what the stock market's supposed to be doing.
So from the sector level, the asset allocation level, have you increased, decreased, or kept your tech exposure the same here?
So we continue to like holding tech and comm services for a couple of reasons. I think first and foremost, if we actually look at the revenue hit that might come through software, we took a look at that and we said, okay, if we took that sector and we took some of these worst case scenarios in terms of the losses around revenue from software, what would that do to the overall revenue for the sectors? It would take it down 5-6%. The market's pricing at around about 3 times that level. So we think, if anything, actually it's cheapened up a long way. And the second thing I'd point out, if we take the Mag 6, or Mag 7, I'm sorry, and we look at their valuation relative to the rest of the market, it's below the trough that it was at on Liberation Day, the last time we had a big market turmoil event. So if anything, relative to its average valuation to the rest of the market, it's looking pretty cheap at the moment.
How about U.S. versus rest of the world? Because we were patting ourselves on the back last year with the U.S. S&P and the NASDAQ, but boy, lots of markets outside of the U.S. did appreciably better, and that's continuing into this year. How do you think about U.S. versus rest of the world?
To me, it's as much as anything else a currency story.
Okay.
If I'm a European-based investor and I bought a global 60-40 priced in dollars, I did about 3% last year. If I talk to someone based here in the US, of course, they haven't had that currency translation. They've done about 17% on the same portfolio. That dollar hit has been significant. And I think, people talk a lot about this whole sell America idea. We just don't see it in the data. What we do see is a repricing downwards gradually of the US dollar, and we think it's got a little bit further to go. So I think we're getting 2 things going on. First and foremost, stimulus like we've not seen before coming through in Europe at long last. A bit more to come in China and Japan as well, which supports the growth in those regions. But secondly, we've got the dollar gradually weakening, which of course accentuates the interest in having that international exposure.
John Bilton with us. We're going to come back and really take advantage of his twisted education here to talk about all this AI uproar. And had a global multi-asset strategy at JPMorgan Asset Management. Futures up 6. Nice green to the screen right now. There's been a lift to the market after all, of course, back and forth on NVIDIA. Young Ives will join us in the 9 o'clock hour. The conversations on NVIDIA today, Paul, have just been absolutely spectacular.
Yeah, I mean, again, a solid quarter. It's a beat and raise, as the tech kids like to talk about.
That's good.
Is it on the magnitude that we've seen in the past? No, but I mean, the law of large numbers, if nothing else, would make that kind of difficult to do.
Well, we'll have to see here. I mean, it is 8:30, and then in an hour we'll open the market as well. Let me get this up right now. Sweetie ahead of me is now, but claims come in below, and a revision is 208,000. I mean, I'm sorry, it's what we're hearing. Across the board. I mean, the labor market just hasn't cracked. And at the same time, the struggle of so many Americans.
Yep, absolutely. So again, the initial jobless claims came in at 212,000. Consensus was 216,000.
Right.
Last period was revised a little bit higher to 208,000. So there you go, Tom.
So much of this AI debate that we're having, and what great informed conversations, is about this strange word productivity, which comes down to efficiency. John Bilton of JPMorgan is exquisite on this. He's got legit chemistry chops out of the United Kingdom and enjoyed a tour of duty on the Charles River at Solos, MIT. So in chemistry, the iconic 19th century shift, including the statue of Faraday on the River Thames, is to move from batch chemistry to flow chemistry in pipes. The world changed. We went from medieval Sir Isaac Newton alchemy to like DuPont and other giant chemistry companies. Then you go over to MIT where you learn productivity with the troops there. How does AI become a process where we win down the road?
So you're talking the Haber process, of course, which takes me right back to my undergrad days. But how do we think about productivity? Stock and flow is incredibly important in any element
100%.
of economics.
I knew you were going here. I set him up for this. Discuss the...
So what allows either to be more efficient, what allows the flow to be more efficient is a better idea of what the dynamics and the data are describing that flow. And that's something which AI can do. What it doesn't do is make the decisions around how to influence how that flow is going through. That's what a human being does. But where AI, I think, has something which we can really lean into is that ability to help us quickly parse through data and understand the problem set. It doesn't mean that suddenly it educates us, but it informs us. And I think that's an important subtlety.
No, good. If you're helping Jamie Dimon write his annual letter, we know you are. You're going to get 2 paragraphs in it this year. The stock is the water in the bathtub. I would suggest, and this is all the heritage of my family, that we will see the water in the bathtub clearer and better with all this innovation. Do you agree with some of that idea?
I would agree with that. I would also agree that what you can do is you can optimize how it flows. So if you've got the plug out of the bath, you've got the tap running into the bath, that's the classic old stock and flow view of the economy, you're able to see both what's in the bathtub much better. You're also able to see an optimal way to have it flow through the bathtub. And I think that's, if we want to use an analogy, that to me is what productivity is about. And that's where AI can be a helpful tool. It doesn't replace the person stood there looking at, and this is the beef I have with some of the moves we've seen in software, the idea that all of a sudden AI can do everything. We know AI has its limitations and is prone to hallucination.
Right.
It requires that interface, but it can create a clearer picture in combination with that human expertise. And that to me is why we're seeing this interesting situation. 210,000 on jobless claims a few minutes ago, below expectations, yet we're not seeing wage pressure. Right. And that's because jobs are becoming more productive using the AI inputs and technology
Can you
inputs.
come back the second week of March? Paul wants us to do thermodynamics. Yeah. Can we do some entropy?